My name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the hour is Peter St. Onge, who I'm sure many of you have seen, fellow at the Mises Institute. I've had a number of Mises Institute people on these spaces, Peter, but introduce yourself. Who are you? What's your background? How'd you get involved in economics and markets? How'd you get involved in the Mises Institute? And what are you doing currently?
Sure. I'm an economist, former professor. My day job is at Heritage Foundation. And then I've also been a fellow at the Mises Institute for going on about 10 years. And I started out in corporate strategy, and that kind of brought me to economics, and specifically brought me to Austrian economics. I felt like mainstream economics does not run on realistic assumptions of how the world really works. And when I was in corporate, I worked in marketing, and of course, marketing economics, mainstream economics have very different views of how humans behave. And on the one hand, marketing has the more prestigious titles and, the image, but marketing, you kind of, if it doesn't work, you're out of there. There's a natural sort of quality control process in marketing. And so that got me really interested in kind of reconciling those two. And for me, Austrian economics which is really just a continuation of 500 years of classical economics. That for me really made a lot of sense.
For those who are not familiar with the school of thought of Austrian economics, just level the playing field a little bit. What do you mean when you say Austrian economics?
Sure. So mainstream economics tends to look at the world sort of from top down. So it looks at aggregates. If you take an example, if you look at a traffic jam, if you look at that from the sky, once it forms, it appears to move backwards because the cars in front are freed up, so they escape, and then the cars in back are still blocked. Right. But of course, that's not really what's happening with, people are trying to go to their destination. They're not trying to back up. And what Austrian economics does instead is that it starts with the question, what are people actually trying to do? So if you take a traffic jam, people are trying to move forward. They're trying not to hit anybody. Okay. And then starting with that assumption, now you've got a much better way to actually model traffic jams. Now, if you take that to everything in life, right, Austrian, it really only makes a couple of assumptions about human behavior. So number one, action has a purpose. People are actually trying to do something. They're not just moving like some central planning army. Number two, people are different. That's why we trade things. That's why we interact. And then number three, leisure is good, which is really just comes out of the first. Now, those sound really simple. And the simplicity is an attraction because it means it's actually realistic. But the amazing part to me is that you can derive the entirety of PhD level economics from those three tiny little assumptions. And if you contrast that with mainstream economics, they just make crap up as they go along. Every single time they're just completely surprised because they really don't have any theories. They just sort of statistically observe things. They say, well, usually this happens. If we go back to 2008, for example, the mainstream was surprised that, houses fell, housing went down in price. They were surprised that the banks collapsed. They were surprised at all these things that Austrians have been warning about for years and years because they have really almost no theory. It's just sort of, it seems to work this way most of the time. And really, who knows? So that for me felt very empty. Whereas Austrian, I think, is much better at predicting what's actually happening. Why are people doing the things they are? Why do we have inflation? Why is the economy going, faster or slower? Even, you're looking at something like de-dollarization, why do people use the dollar today? Why might that change? And all of that is rooted in the Austrian method of always looking through the eyes of the individual involved, right? We are not looking at it like some central planner from on high. We're saying, okay, what are the individuals doing? Why are they buying dollars? Why are they buying Bitcoin? Why are they buying a house?
Yeah, and I think it's fair to say that the Fed probably is along the same lines of what you just said. They make things up all the time, right? Using that term on mainstream economics. I had put out that tweet a number of times over the last several months that FOMO is more powerful than the Fed, which is a very behavioral way of looking at markets, economics, and in general the financial system. I've seen some of your prior videos where you were mentioning the credit crunch that was happening in March, and seemingly everyone forgot about that because price go up.
Yeah.
Right. In stock market. I wanted to get your take on, from the Austrian view, what's going on this year to the stock market in the context of everything that everyone was worried about, seemingly just nobody cares about until They do.
Yeah, it's a very interesting time. If we sort of zoom back to last year, it was a relatively simple narrative, which was that the central banks of the world printed up obscene amounts of money, basically to bribe voters into accepting lockdowns. I think a lot of us, I was in Canada at the time, but, a lot of us in what we thought were liberal democracies and free market countries were shocked at how many people were totally cool with just completely locking down society. And I think what got that kind of support was governments just flushing out trillions upon trillions of bribes. If you're paying somebody to stay home instead of going to work, they can learn to love lockdowns. And all of that money, of course, led to massive inflation, as money printing always does, at which point the central banks of the world panic hiked. So they ramped up rates really at the fastest pace since the 1970s. And normally at that point, you get an economic crash. And this is well known across all schools of economics. This is kind of the standard pattern. The reason why central banks usually try to keep interest rates really low is that they want that sort of tissue fire of fast growth. And so everybody knows that if you hike rates real fast, you're going to crash the economy. And stock markets were saying that last year, right? So the S&P was down about a third. The NASDAQ was not down as much, but it was down about a quarter. And those are the kind of moves that you typically see when you're coming into a recession. And then starting this year, things got weird where the economic numbers continued to drip out badly. So you still had high inflation, you still had the high interest rates. Central banks are still promising that they're going to keep hiking rates, which, again, that makes it more likely to crash the economy. But stock markets have this complete disconnect now where, asset prices still going up. I think we're at a new high we're at a new recent high on the S&P at this point. Markets are just back to partying. We're seeing froth in tech again. We're seeing it in AI. That's kind of the big, exciting bubble at the moment. Keep in mind, bubbles can keep going. No shade to NVIDIA's price. But, when you sort of see these exciting new techs taking off like that, that's typically a hallmark of boom phase. You don't expect to see that, when a recession is on the horizon. So there's this kind of schizophrenia in the markets where we're getting tons of economics numbers that are looking like 2008. So things like, consumer spending, credit card distress, layoffs, corporate bankruptcies. So all of the sort of circumstantial evidence is confirming what all schools of economics would expect, which is that high rates are going to crash the economy, but yet markets keep going. And, in terms of what can square that, I think the two most likely candidates, one of them is that, wait a minute, let me make a note here, right? So one of them is that the market decided that we're due for a soft landing, right? That all of these rate hikes are not actually going to take the GDP or the jobs numbers down very much. And so they got optimistic. There is a possibility of that if what happened during the COVID plunge is that these sort of crappy businesses were already culled. Okay. So normally what happens in a recession is that in the boom phase, when money was really cheap, you had a bunch of crappy businesses started. In Austrian, these are called malinvestments. And then when the rates come up, you get this purge of those kind of marginal crap businesses. Think things like WeWork or Pets.com. And then those fail in a cluster. When they fail in a cluster, you get a bunch of layoffs and then people can't spend money because they don't have a job. And so we call that a recession. And so a possibility, which is interesting, I haven't really seen evidence of it yet, but it's worth watching, is that during COVID, so many marginal businesses were wiped out because of lockdowns themselves that we may have already cleared out a ton of the deadwood so that at this point, we're not looking at a recession after, 10 years of expansion. We're functionally looking at a recession after a year or two of boom. In other words, after the lockdowns, after they pumped out the money. So that's an interesting hypothesis. But at any rate, at the moment,
although I will add on that,
yeah.
it is interesting. It's an interesting point. But that could be more on the private companies. You didn't really have any public stock, go under like you would see in a normal recession.
We haven't yet. Although, if we go back to 2008, typically the bankruptcies come late in the cycle. Companies trying to hold on as long as they can. That was also the case with the banks. Like in 2008, there were a couple of really major bank collapses in 2008. But numerically, the vast majority of the banks failed in 2009, 2010. So it's still too early to say. the overall bankruptcy numbers rising is indicative of a recession. But in terms of, big public companies going under, you don't typically see that until a lot later in the recession.
Right. And most of the time that's on a refinancing wave, right? Which is part of my thesis for why I still think there's a credit event out there. You've got a lot of public companies which locked in very low rates. There's
Exactly.
kind of debt tsunami that's coming, right, for rolling over next year, the year after. If you believe the market's a forward-looking mechanism, the market starts to anticipate that this year, not next year. And that's where it gets to be maybe a volatile period. But it is interesting that, if FOMO were to continue, that keeps credit spreads tight because equities have a smaller claim on assets, right, than debt. So we're in this weird juncture, to your point, where the stock market itself is delaying the bond market reckoning.
Right. Yeah, I think that's absolutely correct. And, it keeps throwing money in. Even with bond yields, they're over 5%. They're much higher than, of course, the average investor hasn't seen those kinds of yields in about 40 years. So even with bond yields or bonds paying so well, still it has not dented stock market frenzy. And that brings us, I think, to a second potential cause, which is just the liquidity, that there is so much money still flowing out from central banks in response to the bank crisis back in March. The Fed pumped out money, and it's possible that essentially we have this overhang from, like in the U.S.'s case, they've printed $7 trillion since the beginning of COVID, and so it's possible that a lot of that money was kind of salted away, and then at this point it's coming out and going not only into bonds but into stocks, and then that then generates kind of a bubble, and people get excited about the bubble, and then the bubble reinforces.
I put out that tweet Assure the Nest in mid-March, this idea that, in a pre-election year, historically pre-election years are very strong for markets. Typically have melt-ups, which you can argue with what's happening now. And that the only way you can have a pre-election year with stimulus is with the manufacturer banking crisis, which it sounds like you'd somewhat agree with. Are we out of the woods on this banking crisis, or was that sort of, if you're going to put your conspiratorial hat on, was the stimulus that and actions taken a way to just keep juicing animal spirits?
That's the big question. So they pumped out just unprecedented amounts of what I call pre-bailouts in the form of two mechanisms, at least in the US. One of them was that they basically pretended that if banks had assets that have gone down, they pretended that those assets were still worth the original purchase price, and then they lend against that, right? And then the other thing that essentially papers over the bank's asset losses, which have been coming from the high interest rates. And then the other thing they did was they're kind of cagey about it. They don't necessarily say it's unlimited. There's legal reasons why they can't do that, but they've sort of hinted to the market that every single bank deposit in America is going to be covered by the FDIC, which is the compulsory bank insurance mechanism. And if the FDIC runs out of money, we actually know what happens then, because it happened back in 2008. The government steps in and makes up the difference, presumably by borrowing it, and then the Fed will buy that debt. And so functionally, the Fed then bails out every bank account in America. So you put those two together, and there are many trillions of dollars, on the order of 10 trillion in theory, mostly from the fully guaranteed bank deposits. But you put that together, and it is possible that they have effectively pre-bailed out the entire system. And so we may not get any more substantial, nothing on the scale of Silicon Valley or First Republic, simply because they're, essentially pouring in trillions to patch up all the gaps before the storm comes. So I would not be surprised either way. We could get more of them, in which case they would probably resolve the way First Republic did, which is to get vultured up by one of the mega banks at a sweetheart price. But I also wouldn't be really surprised if we don't get any more in the near term, because they've sort of pumped out so much backstop into the system. Now, of course, that saves up trouble for the future, because at that point, banks have very little incentive to be prudent. Right? The trick in finance is that always and everywhere, higher risk tends to pay more. Right? So banks have an incentive. Instead of lending on a mortgage, they'd rather lend to some, startup doing something wacky in some exotic location, because the rates are going to be much higher, right? They might be able to charge 10 or 15% on that loan. And so this is a problem throughout banking, that the regulators, on the one hand, they don't want the banking system to crash. On the other hand, if they backstop it too much, then bankers go absolutely nuts. In fact, the bankers who are prudent, they're only going to be making 5% on the money. And so their shareholders are going to be upset with them. And so the entire banking system is forced to chase just wacky business plans, which could go into the froth, right? Where money could be channeled into these sort of exciting .com type industries. And then, they can use that money to grow. And then at that point, they show revenue growth. And so this is kind of a standard pattern where, again, that feeds the bubble process.
That pre-bailout way of framing it, I think, is spot on. I mean, to me, it was. I remember back when the regional bank dynamic would play out, there were these Twitter spaces that were going on all day long, and very intelligent people were making the argument that this is going to be worse than '08. And I would say very loudly, it's like, oh, it's going to be worse than '08. It's not going to happen. It always goes back to the idea that you're not going to have a hard landing catalyst like a regional bank crisis if you can control it, which is what they did.
Right.
So going back to the soft landing versus hard landing, it seems to me that if you're going to have, a hard landing that surprises everybody, it has to be in some part of the marketplace that is scattered, fragmented, that cannot be targeted from a centralization perspective, like the entire banking system. I'm curious if you think that commercial real estate or some of these other things that are put out there is where that hard landing catalyst could come from, because that's a much harder issue to fix. It's not as easy to put on a switch from the FDIC or something like that.
Yeah, and the numbers get a lot bigger in commercial real estate. So there's an enormous amount of commercial real estate that's currently under threat. And that because people are leaving cities and, it happens anyway in this phase of the cycle where commercial real estate tends to be less attractive. But then on top of that, especially a lot of American cities have become unlivable. And so that's taking, half or more off the value of commercial real estate. And that sums up to something like $8 trillion. And that's a problem because it is overwhelmingly concentrated in community banks. So the major New York banks don't invest in regional real estate. They don't know much about it. They will tend to take the money and lend it either to large corporations or they'll lend it overseas, right? They'd much rather make one loan of $1 billion than, thousands of loans of $1 million each. So they tend to move money that way. Whereas the regional banks, they're the ones who know their area. They know who's creditworthy. They know, what kind of property has a future. So if commercial real estate goes down, then the hit is going to be overwhelmingly on those community banks. And, given the pattern so far in how the Fed and Treasury have responded to the banking crisis, I would expect they'd probably do more of the same. So they would essentially try to guarantee, do those pre-bailouts to head it off at the pass. But in the process, it's very likely that those community banks are probably going to get worked out, meaning liquidated and sold off to a larger bank. And so that's probably going to drive continued concentration in the U.S. banking system. The U.S. banking system since the 2008 crisis actually shrunk by about half. So we have about 4,000 fewer banks than we did back then. And the weird part is that before 2008, people were starting banks all the time, something like 50 a month. And after 2008, it was like roughly zero. I mean, it just completely stopped. Nobody starts banks anymore. And, that was because Wall Street essentially wrote the regulations that were imposed after 2008. They broke it, but of course they get the right how to fix it, right? And the way that they thought would be good to fix it is to essentially ban anybody entering the bank industry. So it's kind of a slow motion takeover of the American financial system. But if we do see commercial real estate hit, then I expect that's going to gut community banks. Given present trends, that will be contained at $1 trillion cost to taxpayers. But on the other hand, it'll probably also take out a bunch of community banks and further concentrate the U.S. banking system. Of course, as I mentioned earlier, once that money is in New York, it doesn't come back to Omaha in the form of, hotels and offices. Okay. A big chunk of it tends to go either overseas or it goes to mega corporations who are, it's a lot more fun to write a big loan to them.
Of course, banks have not been created, but a different type of instrument has been with Satoshi, Bitcoin, and assisted currency side of things.
Yeah.
Right. So, which is interesting. That's I'm trying to find a pivot to
Oh, we can just do, okay, let's talk about Bitcoin.
Yeah, no, please. And I'll preface this by saying, I'm pretty loud and aggressive in countering narratives, right? So I'm not anti-Bitcoin. I'm just anti-narratives. Like I think, to me, the definition of the market, it's not just to me, just factually, the definition of the market is more than just stocks. It's all assets. Bitcoin's a part of that. So it's all about sizing. This is like more from a fiduciary financial advisor type of perspective. But a lot of the narratives that have been put out there, I think, on Bitcoin are wrong, just in terms of inflation hedge, store value, because that's tail risk, I'd argue. Lay out for you how you think about Bitcoin and cryptocurrencies, differentiating between the two, because Maxi's, always making a point to differentiate between the two.
Right.
But give us your thoughts on that.
All right. So first, crypto versus Bitcoin. So generally, I don't have a problem with crypto in general. Like BitTorrent, for example, if you remember file sharing, that was a useful thing. Nostr is a useful thing. Okay. Any decentralizing technology, I'm a big fan of, because I want people to be able to route around the state. So I don't hate crypto for those kinds of applications, things like Filecoin. But when it comes to money, I think that Bitcoin is pretty much by far the dominant solution to the sort of digital gold question, meaning, the best alternative outside gold to fiat currency. So mostly, therefore, I do focus on Bitcoin. And I think what happens with Bitcoin is that you've got a long run Bitcoin and a short run Bitcoin, right? So the long run Bitcoin is based on its fundamental characteristics, which are designed to be almost identical to gold. So it's produced at a predictable and very low rate. The inflation rate, I believe at this point, is actually lower than gold. In other words, the percent of supply that is newly created every year is actually lower than gold. It has a number of features that I think are better than gold. It's obviously easier to use over distance. If you're using gold coins, it's going to be very hard to buy things on Amazon, which means that gold necessarily has to have some intermediary. Right? For example, if we imagine a gold-based economy, then, realistically, it would have to be a credit card or something that has gold backing, which is good. I would love that. But of course, the problem is that once you've centralized your gold, now government has control over it. So I think that decentralization, that's called sovereign immunity, also the supply, I think that Bitcoin has a number of features that beat gold. But having said, that's kind of on an architectural level in the long run. Right? In the very short run, there are still relatively few people who either understand Bitcoin or who use it. Gold is a much deeper market. Gold, I think, is more intuitive for a lot of people. So I'd make the argument that if fiat is going to die, which I don't think it's going to die in the near future, I think it's got a ways to go yet to fleece us all. But if it were to die in the near future, then I think that we would almost certainly go to gold. If fiat is not going to die for the next 30 or 40 years, then there's a good chance that we will go to Bitcoin and skip the gold stage. But, and then, you can infer what the market price of those assets should be based on those probabilities and the timing. So we take gold, for example. I've done kind of back of envelope and concluded that something like 98 or 99% of gold's value is actually speculation that it will be a money someday. Gold itself, for its industrial and jewelry uses, that's almost none of it. It should be roughly what silver's price is in terms of those. Almost all of it is coming from monetary speculation. And so for monetary speculation, we can just tease it out, right? So take Bitcoin, you say, okay, there will ultimately be 21 million of the suckers. And so we can take the global money, roughly 120 trillion. We can divide that by 20 million, 21 million. That gives us a price of presto 6 million. And then if we think that that's not going to happen for 30 years, then you discount that, whatever you think the rate's going to be. And so I think that that's fundamentally the value proposition for Bitcoin is very forward looking, right? Bitcoin is not widely used to buy things today. There are technologies that will help it do that, like Lightning, but those are based on uptake. They're not there yet. They're not quite ready for prime time. So I think there's still some R&D to go with Bitcoin before people will actually regard it as a dollar substitute in the here and now. So I think rather people are more looking to that kind of gold thesis for future value.
Yeah, and part of that is just about volatility dynamics in general, drawdowns, right? I mean, I would argue gold is not a store of value either, because anything, again, that has tail risk, right or left, can't be predictable because you don't know when the tail starts to wag. But the other part of this, I think, is there is this aspect of leverage when it comes to gold versus Bitcoin. I mean, it's a lot easier to leverage Bitcoin, cryptocurrencies in general, than gold to be multiples of, whatever it would be. That makes it much more difficult to be widely adopted because leverage inevitably leads to the tail events.
Leverage in what sense?
Well, just leveraging up, buying up 3x, 4x, 5x up Bitcoin or Dogecoin. There are plenty of institutions that do that. Gold, you can't necessarily do that as easily, I'd argue.
Yeah, I mean, you can do it. There are, financial assets, futures, options. I mean, there are ways that you can play both markets, right?
Yeah, no, I guess the point of the speculative nature when you look at leverage in the crypto space is, I think, higher than gold from what I've seen. Could be wrong on.
Yeah, in terms of price movements, for sure, it's a thinner market, and generally, as markets mature, as they have more people playing in them, that volatility likely come down. But even with gold, just sort of to zoom out on a meta level, gold, since it has been fully demonetized in the 1970s, gold has had periods where it's doubled or dropped in half within a couple of years, right? Normally, for any asset like that, right, if somebody came to you and said, oh, okay, I have this suggestion, all right, I got this asset. Sometimes it doubles, sometimes it drops in half, but we're going to make that the money. Okay, you would say that's crazy. It'll never work. It's way too volatile, right? And of course, the reason that gold is volatile, I mean, gold is obviously good money. It's worked for a long time. But the reason it's volatile is because it is currently not the money. And so whatever asset is not the money is much, much more thinly traded. And so a lot of that volatility comes from, it's a question of where gold is at this moment. But intrinsically, we know from thousands of years of history, gold is extraordinarily stable. I think the last major disturbance in gold was the gold rushes 150 years ago, and maybe the Spanish conquest of the Aztec or of the Inca. And other than that, it's pretty darn stable. So I think that Bitcoin, you've got a similar situation where it's extremely volatile now, simply because it's very thinly traded. A lot of institutions feel like it's a gray area where they don't want to invite the scrutiny of regulators, and so they stay out of it. And so you put those together, and I think it's a lot more volatile at the moment than it will be in the future. But that does mean that the uptake in the here and now is also slower. If the kinds of people who are open to Bitcoin have, they're just not that rich, then that's only going to move the price so much.
Just to reset the room for the remaining minutes here, everybody, please make sure you follow Peter here on Twitter. If any of you have any questions, click that bottom left mic request button. And as always, this will be a podcast under Lead Lag Live on all of your favorite platforms. Again, another transition now to de-dollarization in general. Okay, so this term de-dollarization is out there quite a bit, and you always get people super hyped up,
right,
and talking about this idea of the dollar's dead, and it's like, you can go to any decade and you'll see similar stories. Not to kind of diminish what may be happening here, but layer for the audience just what's going on with de-dollarization currently, and what does even de-dollarization mean?
Right. So de-dollarization means when foreigners stop using dollars in the kinds of quantities that they've been using them for 70 years now. And that process has been ongoing for decades. The dollar has been slowly losing share of both international holdings, so like governments holding reserves, and also foreigners saving money. Right. Those are the two main sort of sinks of dollars that are held overseas. So that's been dripping away slowly. And last year, it really took off after the U.S. put sanctions on the Russian central bank. So specifically in response to Ukraine, the U.S. seized the sovereign dollars of the Russian central bank. And they did that to try to crash the Russian economy. But what it did was put every country in the world on notice that if the U.S. doesn't like you, they're going to go ahead and crash your economy. So even during the Cold War, when the U.S. and Soviets had, proxy wars, hot proxy wars going on all over the world, the U.S. never did that. And the reason is because it understood that the larger goal for the U.S. is to maintain hegemony in the global financial system. And so the way you do that is by letting your enemies use your currency, right? You don't want to weaponize the currency. So anyway, they did that. That led to a huge plunge, something like 7%, according to Stephen Jen, who's a well-known currency strategist, in global reserves that are held in the US dollar. Now, meantime, another big application overseas of the dollar is, of course, in trade. And China is pushing as hard as they can to try to knock the dollar out of trade pairs. So for example, so that Saudi Arabia can sell their oil in other currencies. They're trying to get countries to trade using their own currencies. So for example, Russia and India would use rubles or rupees, not at the moment because Russia's on the naughty list, but in the long run, they're trying to diversify away from the US dollar. So you put those two together, US sort of hyper aggressive foreign policy that's now tied to the dollar. You put that together with China's efforts, including bribing countries. They use development bank loans to try to get countries to switch into the yuan and away from the dollar. So you put those together, and the risk is that it accelerates the de-dollarization. In other words, foreigners no longer wanting to hold that many dollars. If that happens, then you end up, if we sort of zoom out, the world has something like 3 times more dollars than Americans use. 2 to 3 times more dollars than Americans use. There's this massive overhang of dollars floating all over the world. And those are either parked in governments, central bank assets, they're parked in corporate treasuries, right? So Japanese banks hold enormous numbers of dollars, and they're held by individuals. So, if you're a rich Mexican, you are not putting your life savings in pesos. You don't trust the peso. You're keeping a little bit of pesos for your day-to-day needs, and the vast majority of your money, over the past decades has been held in dollars. So as all of those go down, or if those, start to go down faster, then that then scares the rest of them. The process can accelerate. And if sort of in the limit, if we zoom out to ask, okay, well, what happens if the whole world doesn't want dollars anymore? Or at least if the dollar plunges to the point of, just in proportionality to the size of the US economy. So if that were to happen, then you would have these potentially $10 trillion that would be essentially flooding back into the US. And, it's worth noting the only people in the world who are actually obligated to use the US dollar is, of course, Americans. We have legal tender laws. You must use it. And so if that massive flood of dollars comes rushing in, then you can see double-digit inflation for multiple years.
It sounds to me like you think that it was a foreign policy mistake to weaponize the dollar.
I think it was a massive mistake. Absolutely. You want your enemies to be dependent on you. There were many other mechanisms. I mean, they are using those as well. But the seizing of the dollars did effectively nothing. The Russian bank system did not collapse. In fact, the US banking system came close to collapsing, ironically enough, for separate reasons. But right, it didn't work. And they've now seeded doubt in all these countries. The president of Indonesia, he was just at a conference. This was earlier this year, where he was saying, we have to look at alternatives because look what happened to Russia. Okay, so countries, they have eyes, they have ears. They're seeing this happen. The US is now, they're putting pressure on countries over social policies, things like LGBT. And, those, if you're an African country, Africa is extremely socially conservative. Okay. If you're an African country and you feel like the US might come down on you because they don't like your policies, forget invading your neighbor. Maybe they just don't like your social policies. That is going to influence these countries to shift out to other currencies. If you're a Middle East country, really the entire Earth or the entire non-West is far more socially conservative than the West. And so this is creating doubts for all these countries.
What are the real viable alternatives, though? I mean, I think the argument that's often out there is the reason why we have the reserve currency status is because of that legal framework, right? I mean, that we have property laws, that we have things that, make the currency protected in terms of what you're using it for. Whereas, with China, they can just claim eminent domain on everything, right? I mean, it seems to me like it's still a hard thing to try to deal with if you're another country to try to de-dollarize when you can't necessarily trust other countries either.
For sure. And that's where, you have to beat something. What is it? You can't beat something with nothing. And the alternatives, some of them are, other currencies. So the euro, the yen, the Swiss franc, the Canadian dollar, those can only hold so much, but they do offer the attractive feature that the government doesn't try to steal them from you if they don't like you, at least not yet. Some of the demand and all of those currencies are growing over this past year because of that flight. So the Japanese yen, I think is up something like a third or 40%. Now that's still a small base, right? So it's going from like 2% to 3.5% or something of global reserves. So it's still small, but the point is that the speed is quite fast. And if that speed accelerates, particularly that's over a period when the US price has been holding up pretty well. The US dollar tends to do well whenever there's distress in the world because it's like safety. So and also because US rates were abnormally high. So if that changes and then countries start, or the US dollar starts actually going down rapidly, then you would expect that process to accelerate. And then something like the yen goes to 10% or whatever. Then multiply that across the euro, the other first world currencies. You're already seeing that process in gold. So central banks all over the world are diversifying into gold. Some are flirting with diversifying into resources. So, China especially, but Ghana, for example, has talked about holding gold because it's a gold producer. Other countries might want to do that with oil. So there are these alternatives to the dollar. None of them are great, which is why, they're only picking up a small percent of the demand so far. But again, the risk here is that if this process accelerates, if it's paired up with a dollar that's actually losing value now, sort of the big one, which is the BRICS currency. So that's the one that I think is getting the most attention these days. And the idea there would be that, none of the BRICS members have a very attractive currency. Russia and India have been negotiating over trading in their own currencies. And basically neither of them want their own currencies because they're inflationary, they're very liquid. And, China, of course, the yuan is not freely tradable. China has enormous capital controls. And so one suggestion is that the way that these countries can get around that is by creating some sort of BRICS currency. And the sort of nuclear option there would be that they actually gold back it. And I've talked about this, the Russian embassy in Kenya, which is kind of a comical source, but anyway, they announced that Russia was going to gold back the dollar. Russia flirted with this early in the Ukraine conflict. They actually kind of did it backwards. They required gold miners to sell them gold at a fixed rate. So that's kind of the opposite of gold backing. But anyway, both China and Russia have hinted that they may want to back a currency with gold. They would not back their own currencies because that would make their exports expensive. So no country wants an expensive currency these days. Rather, if they were to do that, then they would gold back some kind of BRICS currency. It would probably only be used for trade initially. They'd be looking to create a replacement for the US dollar, sort of a trade rail that insulates their home economy. I don't think that's likely. Partly, it's just really outside the Overton window, I think, for modern central bankers. If they were to do that, then that would be a significant threat to the dollar. If you could actually take your BRICS currency and you could trade it for gold, and if you trusted the custodian of it, right? So not necessarily the Chinese government, they would have to have some trustworthy custodian in that kind of a world. Then yes, I could see enormous demand draining off from the dollar. To give a flavor of one country that did something similar, Dubai. When Dubai decided that it wanted to be a world champion and wanted big companies to go there, one of the concerns was that some people were concerned that Dubai doesn't have a completely transparent legal system. So they were concerned about corruption or, basically being held hostage like China does. And so what Dubai did is they set up a kind of a Supreme Court using retired British judges, who were located outside of Dubai, right? So there are ways that you can work around this credibility issue. And if the BRICS were to go that route, then there are ways that you could establish trust. It'll take a little while, but after a couple of years, if people actually believe that a BRICS currency is gold backed, then that I think would be a complete game changer for the dollar.
What will be the U.S. government response to that? I mean, presumably there's still some trips they can play.
Yeah, that's kind of the big question, the whole petrodollar thing. And given how stupid the Russia move was, seizing the central bank dollars, I'm not sure that the whole petrodollar Leviathan or Illuminati is quite what people think it is anymore. I don't know that it ever was. I mean, it's true that, typically whenever some country would announce that it's going to go with gold, something bad would happen to its leader. That is without a doubt true. But this Russia move was so boneheaded that I have to conclude either the black helicopter men are out of the conversation for some reason. Maybe they're overruled by, the idiots in the White House. So for whatever reason, in theory, they could try to counter this. The U.S. is already putting maximal pressure on, China, for example, on a range of topics such as industrial espionage. They're not making much progress on that. So if China were to go with a gold-backed currency, we could imagine the U.S. punishing other countries, hangers-on like South Africa or Mexico has expressed interest in BRICS. So you can imagine the U.S. trying to intimidate those countries, but ironically, that would also play into the original complaint, which is that the U.S. is monetizing the dollar and its economy.
I want to pivot a little bit here for the remaining minutes to China. You had put a video out saying China's $50 trillion debt risks Japan-style slowdown. I think you can also maybe say that about U.S. government debt,
For sure.
when you factor in the unfunded liabilities. Yeah. And I want to relate that to de-dollarization too, because I've got to assume there's a link between debt, inflation, trust, and reserve currency status, right? In kind of a mosaic of sorts. What's your thought process on China here in terms of it as an economic powerhouse, in terms of its own debt? I've been myself pretty amazed that despite the reopening, it seems like they're headed towards outright deflation and the PBOC is not necessarily acting.
Right. Modern governments can, by the way, they can very easily fix deflation by simply printing up great scads of money. But in this case, right, China is constrained because it is absolutely swimming in debt. And I think if you sort of zoom out, the big picture here is that the China that most of us think of, with the 10% growth rates, that hasn't been true for a long time. Ever since Xi came in about a decade ago, he's cut growth to about 5-6%. That's not bad, but that's typical of a poor country. It's not the China that it used to be. And a big reason for that was that Xi prioritized control over economic growth. So his predecessors had basically said, leave the private market alone, let it grow at its pace. You do that kind of thing, and yes, you'll get 10% growth. He's not as extreme, but he's a bit more on the North Korea side where he says, I don't really care if my country's poorer. I just, I don't want to have any domestic threats. And so Xi has gone after a lot of industries, especially tech. He felt like their domestic tech industry was sort of developing a power center that could threaten the central government. He went after Jack Ma. Jack Ma, the founder of Alibaba, domestically, he's sort of seen like a Bill Gates, right? He's like a heroic inspiration to all the Chinese in business school. And he actually disappeared for a while. So Xi has been hyper aggressive on the control at the expense of the economy. Now, at this point, sort of to make up the gap of the slowing economy, they double down on stimulus, on debt. This is something that's also happening in the West where you have economic mismanagement and then they try to paper it over with additional debt and stimulus. But China has very much played that game. And so at this point, I think near term, China is going to go slower. That's going to cause problems for Chinese who are accustomed, if, they sort of expect that 10% growth as a birthright. And, they've been frustrated under Xi. Xi has, an enormous police state domestically. So I'm not sure if he's threatened. If he is, however, then I can imagine a sort of Taiwan scenario where he sort of rolls the dice and figures that if he's doomed, then he's going to do something dramatic. I think that's unlikely, but that would be a sort of caution if Xi does feel threatened. But in the meantime, what I expect for China, I think in the long run, it has bright prospects. A lot of sort of Chinese skeptics want to claim that it was all built on smoke and mirrors. I don't think that's true. I think that the actual growth from, say, 1990 into 2010, I think that was very real and that Western policymakers could learn from that. But having said, I think in the near term, the Chinese economy is sort of a slave to Xi's own paranoias, President Xi. And so there's a good chance that they're going to be slow for the next couple of years.
That point about being threatened and then Taiwan was interesting. You've probably seen the same stats that I've seen around youth unemployment in China, right? And it's like, if you're going to be threatened, you're going to be threatened by a younger generation that's fed up with not having a job. Now, the other counter to that is, this is my cynical hat, I'm a big believer that a lot of the push towards like a metaverse and virtual world is largely to get the youth that are unemployed to not realize, that they're unemployed because they're living in this virtual world. But the unemployment part of it on that side, that's an interesting link perhaps to the idea of China going to Taiwan if that gets to be really out of control.
Yeah, there is. And people specifically are worried about that. I think it'll be a cage fight between if the economic weakness continues, it'll be a cage fight between dissatisfied youth and the Chinese police state, which is formidable. In Hong Kong, it was quite impressive in a horrific way what it was capable of. So yeah, we'll discover at that time how that thing works in practice. I think people don't understand that, for a very long time, China has been extremely unstable domestically. If you go back before Xi, there was something like 800 riots in the country per year, and none of these were reported in the West. You would almost never hear about them. So China is a lot more rambunctious, I think, than people realize. And that's part of the reason why the Chinese state is so aggressive on the police state. It's not Japan in terms of public obedience. It's a pretty wild place. And a lot of these guys, they have memories of the Cultural Revolution back in the 60s where top party cadres were thrown out windows. Their children were crippled because people were angry. So the Chinese regime, I think, is paranoid. I think it's got some reason to be. And so, during the fast growth stage, they didn't have anything to worry about because people were just thrilled that, they could have a refrigerator or a scooter. But at this point, if people get disappointed, then yes, so the rubber hits the road and we see how that police state performs in reality.
Everybody in the audience, please make sure you follow Peter here on Twitter. Peter, for those who are outside of Twitter listening to this, where can people find some of your content?
I do a weekly newsletter at profstonge.com, PROFSTONGE. And I spend most of my days hanging out on Twitter. You can also catch my videos on YouTube.
I encourage everybody to subscribe to Peter's YouTube channel as well as his podcast. You can tell very thoughtful. I saw a lot of people saying that you're one of the goats, Peter, on Twitter. So it's good to have that come from an anonymous account to keep by the way, in fairness. But again, everybody, please make sure you follow Peter. I think that's a good place to wrap this Twitter space up. Thank you, Peter. Appreciate it.
Okay, Michael, it's fun.